Imagine a machine that turns money into more money. Every single month, it pays out 1%, never more, never less. Markets crash, wars break out, banks collapse, and the machine keeps humming. 1% every month for 40 years. Thousands of the smartest people on Earth looked at this machine. Bankers, hedge funds, billionaires. They all asked the same question: how does it work? And when they couldn't figure it out, they did something incredible. They gave it their money anyway. The machine was a man named Bernie Madoff. The machine was a lie. And by the time it stopped, $65 billion had vanished into thin air. This is the longest-running financial fraud in modern history, explained so simply a 5-year-old could follow along. Let's start with who Bernie was, because it matters. Bernie Madoff wasn't some fast-talking outsider. He was Wall Street royalty. In 1960, at 22 years old, he started a small stock trading firm with $5,000 he saved from lifeguarding and installing sprinklers. And here's the thing, that firm was real and it was brilliant. It pioneered electronic trading before almost anyone else. It became one of the biggest market makers in America. Bernie even served as chairman of the NASDAQ stock exchange. When regulators had questions about how markets should work, they called Bernie for advice. Remember that, because it's the foundation of everything. The man running the biggest scam in history was the same man regulators asked for help writing the rules. Now, alongside the real business, Bernie ran a second, quieter business, managing money for investors. And this is where the machine lived. Here's what investors saw. You give Bernie your money. Every month, your statement shows a gain of about 1%, around 10 to 12% a year, like clockwork. In good years, the market might do better than Bernie. In bad years, the market fell off a cliff, and Bernie just kept going up, 1% at a time. Steady, boring, beautiful. When people asked how, Bernie gave them a fancy answer, a strategy called split strike conversion, involving stocks and options working together to smooth out the ride. It sounded sophisticated. It sounded proprietary. And if you pushed for details, Bernie would politely show you the door. He'd say, if you don't trust me, take your money elsewhere. And that little move, that velvet rope, was pure genius. Bernie treated his fund like an exclusive club. He turned investors away. He made people beg to give him their money. Think about that psychology for a second. When a salesman chases you, you get suspicious. When a club won't let you in, you'll do anything to join. So what was actually happening inside the machine? Here's the 5-year-old version. Imagine a kid named Bernie collects allowance money from his friends and promises to grow it. But instead of investing it, he just puts all the cash in a shoebox under his bed. When his friend Timmy asks, how's my money doing? Bernie writes a note that says, your $5 is now $6. He made the number up. The money's just sitting in the shoebox. Now what happens when Timmy wants his $6 back? Simple. Bernie reaches into the shoebox and pays Timmy with the other kid's allowance money. Timmy walks away with $6 real, telling everyone Bernie is a genius. And as long as new allowance money keeps flowing into the shoebox faster than kids ask for it back, the game never ends. That's it. That's the whole scam. It's called a Ponzi scheme, named after Charles Ponzi, who ran the same trick in 1920. Bernie didn't invent it. He just ran it longer, bigger, and more politely than anyone in history. There were no trades. Let that sink in. For decades, the investment statements showed thousands of stock trades, and investigators later confirmed that essentially none of them ever happened. The 17th floor of Bernie's office building, where the advisory business lived, was basically a fake statement factory. Old computers printed beautiful, detailed, completely fictional account statements. The fake profits existed only on paper. By the end, those pieces of paper told customers they had $65 billion. The real money that ever came in was about $17.5 billion. The rest was pure imagination, 1% at a time. So the obvious question, how did nobody notice for 40 years? The answer is, somebody did. His name was Harry Markopoulos, a numbers guy at a rival firm. In 1999, his boss asked him to build a product that could match Madoff's returns. Harry ran the math and came back with a terrifying answer. It's impossible. The returns Bernie claimed could not be produced by his stated strategy in any market, in any year. A return line that's smooth doesn't exist in nature. Real markets wobble. Bernie's line went up like a ruler. Harry didn't just shrug. In 2000, he wrote it up and handed it to the SEC, the government agency whose entire job is catching this exact crime. Nothing happened. He submitted again in 2001. Nothing. In 2005, he sent them a memo literally titled, "The World's Largest Hedge Fund is a Fraud," listing 29 red flags. The SEC opened an investigation, interviewed Bernie, caught him lying about basic facts, and closed the case anyway. Why? Partly because they were checking whether the paperwork looked right instead of checking whether the trades existed. One phone call to the clearinghouse, would have revealed there were no trades, nobody made the call, and partly because of who Bernie was. Investigators walked in expecting a legend, and legends don't steal. Meanwhile, the machine kept growing because everyone in the chain was getting paid not to look. Feeder funds collected billions from ordinary investors and passed them to Bernie, skimming fat fees for doing essentially nothing. Banks structured products around him. The people whose job was due diligence had a financial incentive to keep their eyes closed. When one fund manager was asked why he didn't dig deeper, the honest answer floating around Wall Street was simple. Nobody wanted the answer to be no. Then 2008 happened. The financial crisis hit, and suddenly everyone needed cash. Investors weren't asking questions about Bernie. They still believed. They just needed their money back to plug holes everywhere else. Withdrawal requests piled up, $7 billion. And the shoebox, for the first time in 40 years, didn't have enough. Remember the one rule of the shoebox. It only works if new money comes in faster than old money goes out. In a crisis, all money goes out at once. On December 10, 2008, Bernie sat his two sons down, both of whom worked in the legitimate side of the business, and told them the truth. The investment business was, in his words, one big lie. His sons called a lawyer. The lawyer called the FBI. The next morning, agents knocked on Bernie's door and asked if there was an innocent explanation. Bernie said, "There is no innocent explanation." 40 years ended in one sentence. The damage was staggering. Thousands of families lost everything. Charities collapsed. Universities, hospitals, pension funds, Holocaust survivor Elie Wiesel's foundation wiped out. Some victims were billionaires. Most were ordinary people whose retirement accounts had been quietly funneled into the shoebox through feeder funds they'd never heard of. In March 2009, Bernie pleaded guilty to 11 federal crimes. He insisted he did it all alone, which nobody believed, and his top lieutenant later went to prison too. In June 2009, a judge gave him 150 years, the maximum allowed. Bernie died in prison in 2021. Here's a strange twist of the same kind we saw with FTX. A court-appointed lawyer named Irving Picard spent years clawing money back, suing the people who took out more than they put in. He recovered more than 14 of the $17.5 billion in real losses, one of the greatest recoveries in fraud history. Most victims eventually got most of their principal back. The fake profits, of course, never existed at all. So what do you actually take away from Bernie Madoff? 3 things. First, the smoothest line on the chart is the scariest one. Real investing is bumpy. Anyone who promises steady returns in every market, every year, is describing a machine that doesn't exist. Second, trust is not evidence. Bernie's resume, his reputation, his exclusive club, none of it was proof. It was the costume. The more impressive the costume, the fewer questions people asked. And third, the guardians can fail. The SEC was handed this fraud on a silver platter 3 times and missed it. The people paid to check were paid more not to. The scam never changes. Last episode, it wore cargo shorts. This time, it wore a NASDAQ chairman's suit. Next time, it'll wear something new. But it will always make the same promise. Give me your money, don't ask questions, and the number will only ever go up. When you hear that promise, you now know exactly what's in the shoebox. If you want more true stories like this, drawn badly on purpose and explained simply on purpose, subscribe. Next time, the man who watched $40 billion vanish in 72 hours.